So, good afternoon again, everyone. So, my role for today is to answer two questions. First is to answer what's the current status of financial inclusion in the Philippines, and second one is to answer what are the challenges in pursuing financial inclusion in our country. So, hopefully, this will provide context and more background as we discuss the proposed financial inclusion lab. So first, let's have a common understanding of financial inclusion. So what do we mean when we talk about financial inclusion? Actually, there's no standard definition. It varies depending on country realities. But in our country, this is how we define it in our national strategy: effective access to a wide range of financial products and services by all. Simply put, financial inclusion means promoting universal access to financial services in the same way that we are promoting universal healthcare or access to education. So we believe that access to finance is equally important because all of us have financial needs. So for example, we need to save money for the future or for emergencies. We borrow as we go through life stages. We need risk protection through insurance. We accumulate assets through investment. We have daily payments and remittance transactions. But for most of us, we are addressing these financial needs through informal sources, like for example, saving under the mattress or borrowing from 5, 6 lenders. So in the idea behind financial inclusion is that we should be able to access formal financial services that are suited to our needs and requirements. And while there are many financial products and services, our basic outcome indicator for financial inclusion is ownership of an account. So this is not just about bank account, but it can also be an account in non-banks like microfinance institutions and cooperatives, as well as electronic money wallets, so like GCash, PayMaya, GrabPay, to name a few. And this account can be used not just to save money, but to receive salary, benefits, to send and receive remittance, and make day-to-day payment transactions. So from a measurement perspective, we measure financial inclusion from these four lenses: access, usage, quality, and welfare. So when we say access, is about the availability of the financial service providers, the touch points. Usage is about the uptake of financial products and services. So the regularity, the frequency, and the patterns of use. Quality dimension is about consumer experience. So it can relate to affordability, transparency in prices, the treatment of the bank personnel, whether you have choices in products, convenience, complaints, and level of satisfaction. And the most difficult one to measure is the welfare dimension, which is about the impact of access to finance to your life, especially to your financial well-being. So we are guided by the following principles in promoting financial inclusion. First is that the low income and the unbanked can be sustainably served by the private sector. And the role of the policymakers and regulator is to provide an enabling regulatory environment. So admittedly, most financial institutions will perceive the poor as high risk, high cost segment. And with our experience in microfinance, we have proven that the poor can actually pay their loan, they can even save, and they need a wide range of financial services. And they can be served sustainably by the private sector as long as we have the right financial products for them that are suited to their capacities and requirements. And aside from policies, BSP has been pushing for infrastructure that are needed to mitigate the risks. So for example, to address information asymmetry, we have been promoting for effective credit information system. For agriculture and micro, small, and medium enterprises, we have been pushing for effective guarantee system, crop insurance system, movable collateral registry. Of course, the national ID is another critical infrastructure, as well as digital infrastructure if we are to push for digital financial services. Second is that digital technology is a key enabler of financial inclusion. So there are many challenges in financial inclusion that cannot be addressed by traditional finance. So our country, we have more than 7,600 islands, and it's not feasible to set up a bank in each island. So technology provides unprecedented opportunities to reach the last mile. So with the developments such as electronic money, mobile banking, there's no need to go to the physical bank if we can transact using our mobile phones. Third is that Financial inclusion cannot be driven by the regulator or any one institution alone. So as MD Pia mentioned, we have the national strategy, which means that financial inclusion is not a sole responsibility of the central bank. It's a whole of government, a whole of nation undertaking. So with the Financial Inclusion Steering Committee under the NSFI, we have 19 government agencies there. And the private sector has also launched several programs in support of the national strategy. And finally, we believe that financial inclusion can complement and reinforce other policy objectives such as financial stability, financial integrity, and consumer protection. So we call it the ISIP approach: I for inclusion, S for stability, I for integrity, and P for protection. So basically, it means that as we promote financial inclusion, we should also balance it with other policy objectives. So for example, if we want to extend credit, we have to ensure that that expansion of credit will not result in financial instability. So it's a balancing between inclusion and financial stability. If we want more people to be included into the system, we need to ensure that no dirty money will enter the system. So it's a balancing between inclusion and anti-money laundering, which is financial integrity. And if you want to include more people, we have to ensure that once they are included, they will be informed and protected so that they will not be vulnerable to scams and frauds. So that's a balancing between inclusion and protection. So we believe that these policy objectives are mutually exclusive and they can be complementary to each other. So I will now answer the first question, which is what is the status of financial inclusion? So I will answer this in terms of access, usage, and quality. So in terms of access, actually, we have plenty of financial service access points. So if you look at banks alone, counting head offices and branches, we have more than 12,800 banks. We have 21,000 plus ATMs. But are they distributed well across the Philippines? Well, we all know that the answer is no, because they are concentrated in NCR in urbanized areas. And based on our latest tally, 510 LGUs, so LGUs here refer to municipalities and cities, 510 LGUs are still unbanked. That's 31% of the total number of LGUs. And some regions are disproportionately unbanked. This include, for example, the Bangsamoro region, where we have 92% of LGUs there are unbanked, as well as Cordillera and Eastern Visayas, where 56% of LGUs are unbanked. The good news is that for those areas without banks, they have access to non-bank financial service providers, including pawn shops, money service businesses, so these are the remittance agents, credit cooperatives, and microfinance institutions. And that 31% unbanked would be significantly reduced to 5% unserved, meaning only 5% of the LGUs do not have any financial service access point at all. And based on our survey, pawn shops and bayad centers are perceived to be the most accessible access points. And these are also the access points where people conduct regular financial transactions. Let's now go to usage in terms of account ownership. So MDP already mentioned earlier that we have significant gains in terms of account ownership. So this has increased from 23% in 2017 to 29% in 2019. And if you look at the different types of account, you will see here that there's only modest improvement in bank account ownership from 11.5 to 12.2%. And then the account in microfinance institution is at par with banks at 12%, and it increased by 4 percentage points from 2017. The most remarkable growth really is on e-money accounts. And we say that this is remarkable because this means that even before the pandemic, we are already seeing an indication of shift towards digital because e-money accounts are inherently designed for digital payments. And you will also note that among account holders, there's increased usage of account for payment transactions. So from just 18% in 2017, in 2019, 39% of account holders are using their account for daily payment transactions. In terms of demographic segments, we're also happy to see that the highest growth was seen in the lowest social economic class, which is Class E, which grew by 13 percentage points. And then we also observed that the income gap narrowed. So in 2017, the Class ABC is 4 times more likely to have an account than Class E. But in 2019, Class ABC is just twice as likely to have an account than Class E. We also noticed that the gender gap has narrowed. So the Philippines is unique in the sense that we have a reverse gender gap favoring women, because in other countries, women are disproportionately disadvantaged in terms of financial inclusion. But in our case, the financial inclusion gap is favoring women, although the gap is also narrowing as we see faster growth among males. In terms of the urban-rural difference, it's also interesting to note that account ownership is slightly higher in rural areas, 30% rural, 27% in urban areas, which is driven by the presence of microfinance institutions in far-flung areas. In terms of uptake of other financial services, we have seen an increase in the number of Filipino adults with outstanding loans. So it increased from 22% to 33%. But most of these loans are actually informal, as I mentioned earlier. So 44% of outstanding of borrowers with outstanding loans they obtain their loan from family and friends, followed by informal lenders. But for formal sources, the top choice really are microfinance NGOs, followed by government entities. And you will see at the bottom that other formal entities like banks and co-ops are not, the top choices for borrowing. In terms of insurance, we've also seen 5 percentage point increase to 23% in 2019, and most of these are life insurance, microinsurance, and health insurance. For investment, there's a modest increase of 2 percentage points, but most of these investments actually are the contributions to SSS, Pag-ibig, and GSIS, and only 3% of those with investments invest in managed investment schemes like UITFs and mutual funds, and only 2% in time deposit. Now, let's talk about quality. So these are just some of the quality indicators that we were able to capture in our survey. In terms of ease of application for loan, many Filipino adults perceive that it's really difficult to borrow from formal financial institution, and it's almost half of adults think so. And the main reason for the difficulty is because of the lack of documentary requirements. They don't have the collateral, they don't have the ID, and they believe that their level of salary is not acceptable compared to the loan amount. In terms of assessment of fees, surprisingly, more than half of the adults believe are assess that the fees in financial institutions are actually cheaper than what they personally assess, although you will see a fifth of them assessing that it's too expensive or somewhat expensive. It's also common for some financial consumers to experience issues as they transact with financial access points, and 37% of those who perform transactions with financial service providers encountered issues. So what are the most common issues? These include long lines, long service time, personal information was shared to others, system under maintenance, receiving or sending of money is delayed, mistreated by staff, and was asked to go back and forth to finish transactions. So those are some of the consumer issues that encountered by the respondents of the survey. Now, this slide presents the results on digital finance, which is a new module of the 2019 survey. We asked whether the respondents have a mobile phone and access to internet, and whether they use those platforms to perform financial transactions. So 69% of adults have mobile phones, and 75% of mobile phone owners actually are smartphone users, but only 12% of those with mobile phones are using their mobile phones for financial transactions. So in terms of internet, more than half have access to the internet, but only 9% of internet users are using the internet for financial transactions. Now, what are the challenges? So basically, these reasons for exclusion are based on our question on what are the reasons why people don't have an account. And the main reason, we have been running these surveys for 3 rounds since 2015, and the number one reason is always the lack of enough money. Although the share of the unbanked who cited this reason has already declined from 60% in 2017 to 45% in 2019. Lack of need is another major reason, because people do not see the value of owning an account. For most people, an account is just a privilege for those who have excess money to save. What people need to realize is that an account can be used for day-to-day financial transactions. For example, in our survey, we also found out that 9 in 10 adults have payment transactions. Almost all of us have payment transactions because we make bills payment, we pay for our goods and services, and 37% send money, 48% receive money. But most of these remittance transactions are through over-the-counter transactions at pawn shops and money service businesses. So that's an opportunity to convert those payments and remittances into account-based fund transfers. Lack of ID is another major reason. So prior to the passage of PhilSys, BSP has already liberalized the documentary requirements. For example, barangay clearance and certificate of good moral character should suffice for proof of identity. Hopefully, with the PhilSys, this will no longer be a significant issue. So other factors pertain to knowledge, awareness, trust, as well as distance. So what are the current solutions to address these barriers to financial inclusion? So if the problem is not having enough money or having an account is perceived to be expensive, the BSP has already issued the framework for basic deposit account. So this is a simplified deposit account wherein you can open with less than 100 pesos, no maintaining balance, no dormancy charges, simplified opening requirements to address this gap. And of course, another option to BDA are e-money accounts or e-money wallets. If the issue is no documentary requirements, so again, we have the PhilSys. This is under PSA, but the BSP is a very active member of the PhilSys Policy and Coordination Council, and we actually chair the technical working group on use cases wherein financial inclusion is a priority use case of PhilSys. For the third, another reason which is not needed, we've been pushing for compelling use cases of transaction accounts. So for people to realize the value of an account, they should see the use. So that's why we've been partnering with the SWD for the use of account for the disbursement of 4-piece benefits as well as SAP2. Then we have partnership with DOLE for the use of accounts for wage payments. Very recently, DOLE has issued a labor advisory on the use of accounts for wage payments and also the digitalization of payments in the transportation sector. And we also been pushed, we have the national retail system, InstaPay and PesoNet, so that you can transfer from one account to other accounts, even if you do not belong to the same bank or to the same e-money provider. When it comes to issues on awareness, knowledge, trust, of course, financial education and consumer protection is part of BSP's financial inclusion agenda. Actually, our unit, the Center for Learning and Inclusion Advocacy, looks at this trio: inclusion, education, and consumer protection. And during the pandemic, we have been rolling out our digital literacy campaign on how to use digital channels safely as more people use online banking transactions during the pandemic. We have a chatbot called the BSP Online Buddy, or Bob, so that the public can lodge their complaints automatically or virtually to our chatbot. And we have been pushing for the Financial Consumer Protection Act to strengthen the role of regulators in consumer protection. And if the issue is distance, of course, considering that we're an island, there's still many areas in the Philippines with no bank. So we have cash agents, e-money agents. So these are the retail outlets where people can do cash in, cash out, and perform other financial transactions. So the likes of sari-sari stores, pharmacies, or drugstores, and even pawn shops that are offering financial services on behalf of the bank or the e-money issuer. So this is my last slide, and actually it's the same with my previous slide. It's just that in this slide, the initiatives that we have so far launched are arranged in a strategic framework to show how the policies and initiatives are connected to each other and how we plan to achieve our target of 70% inclusion by 2023. So the three pillars of our inclusive digital finance agenda are democratize access to an account through BDA and e-money, expansive network of low-cost touchpoints through cash and e-money agents, and efficient retail payment system through the national retail payment system. So the idea here is you should be able to easily open an account, and you can transact with that account using touch points that are accessible. And you don't need to maintain several accounts just to facilitate payments and remittances, because there is the NRPS that enables interoperable fund transfer. So you only need one account, and you can use that account to send and receive funds from others. So underpinning the three pillars are what we call the enablers. Of course, these are the compelling use cases, infrastructure, and digital literacy, financial education, and consumer protection. So aside from these measures that we have put in place, we are confident that we will, as MDPia mentioned, we are confident that we will be able to achieve our 70% target by 2023 because the pandemic has provided significant momentum towards digital finance. But we also need to ensure that we will address the digital divide in terms of digital literacy and digital connectivity. Actually, in the last meeting of the Financial Inclusion Steering Committee under the NSFI, ICT policy reforms were the focus of the discussions because we really need to address the internet connectivity issues if we are to push for greater adoption of digital financial services. So this is the strategic framework, but some of these policies and initiatives are relatively recent, so we are yet to see the impact of these policies and initiatives. And as Ms. Pia mentioned, we can also look at second order issues or next order agenda, which we can explore in the proposed Financial Inclusion Lab. So if you want to see more results from our survey, it is posted in the BSP website, and you can also email us in case you want a copy of the questionnaire and raw data. So thank you for listening.